For the Case-Shiller 10-city composite, so this is the bigger cities, housing prices are just back to the peak, the previous peak that was in 2005, 2006. But if you actually look on inflation-adjusted prices, real housing prices, we're actually far below the peak, about 20% below the peak, believe it or not.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association, providing benefits and services to real estate investors and rental property owners for over 48 years. With your host, Brian Hamrick from Hamrick Investment Group.
This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. Hello and welcome to episode 257. Housing values have been rising steadily since the Great Recession, and many people, like myself, have been watching from the sidelines while investors and homeowners pay prices we wouldn't have dreamed of 10 years ago. Many investors think the housing market shows troubling similarities to 2008. But my guest today disagrees and believes the housing boom is just getting started, and today he's going to explain why. Bob Fraser is the founder and principal of Aspen Funds, and he has purchased more than 1,000 mortgage notes, earning double-digit annual returns. Today, he's not only going to discuss his optimistic outlook on the housing market, he's also going to share how you can take advantage of one of the most effective and overlooked avenues of real estate investing. Bob, welcome to the show.
Great to be here with you.
Why don't we just start with you telling us a little bit about yourself and how you got started investing in real estate?
Sure. Well, it's kind of a circuitous journey. I actually, I'm a computer scientist from Berkeley, worked as a computer programmer for many years. I started a .com business in the late 90s and raised $44 million in venture capital and grew that business to 300 employees. I ended up winning the Ernst & Young Entrepreneur of the Year award. It became one of the fastest growing businesses in America. And then it all blew up. And after that, did a few little finance gigs, CFO gigs, but I really loved the investing world, but wanted to get out of something in the related to the stock market and got into real estate. Interestingly, a lot of your listeners, I'm sure, love rentals. Well, I am allergic to rentals. I mean, it seems like I lost more money on my rentals, but I'm doing great in notes. But ended up partnering with the real estate guy, my partner and friend, Jim Mafuccio. We started this business 8 years ago doing note investing, and I just love it. It's we can control the variables, and it's just a great place to be.
Yeah, I have to agree. Note investing is a great way to go, and we are going to talk about that. But you have a perspective on the housing market that I think is unique during this period. I know we've had this huge run up in home values, and investors just are finding it very hard to find deals that pencil out and make sense to pursue. What is your perspective on that? Are we near the top, or do you see something else?
Yeah, there's a lot of running room. I've actually done I've done an economic newsletter for many years and really studied the economics. And my goal has always been after watching the .com boom happen. If you started a .com in the late 90s, you were good, And so I really want to understand. You started .com in 2001, not good, right? I want to understand the times, and so I want to invest based on really the timing and understand that when the tide comes in, all boats float, right? So I want to know what the tides are doing. So I pay a lot of attention to economics, and I want to make sure I have economic tailwinds or economic tides that are helping me out. And so there's a lot of running room in real estate.
What are those economic tides? I mean, give us some examples of what you think is going to keep real estate values strong and increasing.
So you realize for the Case-Shiller 10-city composite, so this is the bigger cities, housing prices are just back to the peak, the previous peak, okay, that was in 2005, 2006. Okay, so now for the smaller cities, the prices have slightly increased. But if you actually look on inflation-adjusted prices, it's actually real housing prices. If you adjust for CPI, less shelter. We're actually far below the peak, about 20% below the peak, believe it or not. And so what's happened is, since 2000, let's just say 2005 for our numbers, 15 years ago, if you were to buy a piece of land, build a house, and sell it, you would actually make money. Okay. Today, if you were to buy a piece of land, build a house, and sell it, you would lose money in most markets, except, a few really, kind of luxury homes or other kind of scenarios. Today, you lose it. Well, why is that? Because inflation has been continuing for 15 years. Okay. Price of lumber, price of labor, right? So inflation has been continuing a ramp up, but housing prices took this massive detour down, and they're still not caught up to inflation. So that's one, and on many, value-based metrics, I can show you that generally, housing is still underpriced. So for example, price to rent ratios. Now, in some cases, this is not true. So California and other places, some places in California, but in a lot of places it is true, where literally a principal and interest payment is half equivalent rent. Right? So it's twice as expensive to rent as it is to buy. And what does that tell you? Why is that? Either rents are too high or prices are too low, one or the other. Which do you think is going to happen? Rents are going to come down by half, or prices are going to double. And so in those markets, that's one value-based metric that shows that prices have to rise. The other is replacement cost. Again, so if you look at take a piece of property, you were to a home, and you were to replace that, taking that same piece of land and build a house, would actually cost you a significantly higher number than that house is priced for. Again, what does that tell you? Now, new homes always have a slight premium, but they shouldn't have as large a premium as they have. Again, a value-based metric that shows on a purely value-based metric, homes are underpriced. So what's happened since the crisis in 2005, basically there has been almost no new construction for single-family homes, almost none. Okay, so what happened? I could show you a chart, and if your listeners are interested, we can actually send a deck, and you can put it in your show notes.
For those of you who are listening to this, you're not able to see the charts that Bob is sharing with us right now. However, we do have a YouTube video available, so you can link to the YouTube video, which is in the show notes, or you can just Google it, and you'll be able to see what Bob is sharing right now. So
the first chart I want to show you here is the housing market prices, and if you look at the Case-Shiller 10-city composite, it's only just slightly above where it was at the peak. In fact, it's virtually the same. You look at the smaller cities, the 20-city and the U.S. National composite, they're above. But if you look at the real housing prices, so this is the same Case-Shiller CPI housing price index, but adjusted for CPI, consumer price inflation, you can see it's well below the peak, a good 20-25% below the previous peak. And so as I pointed out, there's lots of running room, because inflation has been continuing on for 15 years, and housing prices simply, while they were overpriced in 2006, 2007, this kind of thing, they've dropped, and inflation has kept going while housing prices took their detour.
Yeah. So just to describe this chart for our listeners, basically what it shows is that at the peak of just before the Great Recession back in 2007, 2008, housing prices were still higher than they are today. And that's after adjusting for inflation, correct?
After adjusting for inflation. Look at price to rent ratios. So again, back at the peak, price to rent ratios were very, very high. We are basically well below the peak on price to rent ratios. So It's cheaper to buy than to rent in many metro areas in America. And so what's again happening is rents have continued to go on a tear, but prices have not kept up, again, because they took this giant detour south. It's going to take a while for them to catch up. So price to rent ratios are a big indicator of value. Here is the month's supply of houses. And of course, this is now a story. I've been talking about this for several years now. There's a massive shortage of houses. And why is that? Because houses have been massively underbuilt for the last 15 years. There's almost no new supply of single family homes. And look at what's happened. So here's this chart shows the new home starts. Okay, and it shows both single unit structure, so single family homes is the blue line, and multifamily is the green line. So once the housing crisis hit, everything crashed. Okay, new construction, multifamily and single family both stopped. What happened is multifamily rapidly accelerated. So lots of new multifamily developments happening. Single family, not. We are still below the lowest point in the last 30 years in single family starts. Why is this? Do people not want to build homes? No, it's economics. Again, 15 years ago, if you were to buy a piece of land, build a house, sell it, you would make money. Today, in most places, in most situations, you would lose money. Why is that? Again, inflation has continued to go, and housing prices have not kept pace with inflation. So we still have this problem. We have a massive supply shortage. Meanwhile, do we have a population shortage? No. Population continues to grow and expand. Millennials are getting money and wanting to buy, and so there's just a huge supply shortage, and there's a systemic problem that's not going away until prices rise.
How does all this translate into advice for real estate investors? Should they be going out and paying the higher prices in anticipation that they'll just keep rising, or what do you advise?
I love certain geographies. And I'm live in Kansas City. This is a buyer's market. This is a seller's market right now. It's a very hot market, but it's a great place to buy. And if you look at a lot of places that I'm familiar with, all throughout the Midwest and even the South, prices. So a principal and interest payment is half of a equivalent rent. So literally, if you're paying $1,000 a month in P&I, that place would rent for $2,000. That's insane. That tells you that that price of that home has to double to be close to its value relative to a home, to a rental. And so I look at places where there's high, very low price to rent ratios. I look for places where there's, the replacement cost for a home is significantly higher than the value of that home. So I wouldn't be buying right now, probably in New York City or in San Francisco, but I might be buying a lot of other places. So I would look at value-based metrics like the ones I'm talking about. But I definitely would be buying real estate. The other thing, and again, I'm not super bullish on multifamily. I do think apartments and multifamily is going to continue strong. I just don't think it has as much upside. So why do I think they're going to be strong? And it really has to do with larger economic picture as well. So when you have mortgage rates at 3%, it's basically free money, right? It's basically free. Inflation is nearly that. So basically it's free. Well, that means what happens when the Fed prints money, that creates inflation. Now, it has not produced consumer price inflation, and there's a number of reasons for that. What it has produced is asset price inflation. And so you're seeing all things going on tear, the stock market, the housing market, and it's going to continue as long as there's an easy money policy. And we're going to continue to see this massive money printing exercise go into assets and it cause asset price inflation.
Do you see that coming to, going over a cliff at some point in the future?
Absolutely not. So if it goes over a cliff, guess what they're going to do? They're going to have another easy money policy. Okay. And why not? Why not have an easy money policy? It hasn't cost anything yet. Now add into the fact that we live in a global world, and you have negative interest rates in Europe. So imagine you're a money manager managing $10 billion of your pension fund. And for that $10 billion, you're going to pay $100 million a year to your bank for the privilege of keeping your money. Are you going to do that? Brian, would you pay him $100 million to keep your money safe?
Not at all. No,
not at all. What are you going to do? Well, you're going to do anything else. You're going to go buy a currency swap, and you're going to go invest in the stock market. You're going to go invest in real estate. You're going to go look for higher growth areas. And the fact is, America's economy is quite strong. It's a great place to invest. We have lots of financial plumbing. America is a fantastic destination. And real estate is actually quite a bit cheaper than in Europe or Asia or wherever else. So it's actually, this is a great investment destination. It's simply going to continue. So, and as I pointed out, the cliff you're looking for, if that happens, so means price to rent ratios would go even lower. Instead of a $1,000 P&I payment, it's a $500 payment, but equivalent rent of $2,000. It's not going to happen. It's just not going to happen. So many people, I've been through, 4 crashes now, and I know I don't look it, but yes, I have been, and the thing that I know about every crash is people will always be looking at the previous crash and guarding against the last one, but that every crash is different than the one before it, completely different. So the dot-com boom, the crash was totally different than the 2008 crash, totally different than the S&L crisis. And so they're just different. And this is not, there's not been the big short crazy speculation that we had is not going on right now. People are not leveraging, every bartender leveraging to buy a second home, on liar loans. It's not happening. And if you look at even underwriting, so I think I have a chart on underwriting. Looks like it's not part of this deck, but in the crisis, very few 700 FICO scores. Today, almost all the scores are in the 700s for new purchases. So you have much higher credit. It's not the liar loans that we had in the past.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. So Bob, yours is definitely one of the more optimistic outlooks that I've heard recently. How far out does your optimism extend? Because I've heard other economists make very similar arguments, but they see us having a similar crash to what happened back in 1929 happening here for us in 2029, somewhere in that area.
2029, so 10 years from now. I mean, it's pretty hard to have a 10-year crystal ball, but it really depends on what happens. I do not see the rampant speculation going on right now. Again, people are leveraging up to, and lying about their income to buy loans and to buy property and buying second property. I'm not seeing any of that. I'm not seeing the shoddy underwriting. We're not seeing the sausage making that they did, to turn these subprime loans into AAA paper. We're not seeing any of these things happen. So to say there's a 1929 really would have to mean there's a greater economic reality. And the truth is, had we not had a stimulus, we probably would be looking at that. In my opinion, we'll never again see 1929 as long as we have decent financial leadership in this country. And the reason is in 1929 they were on the gold standard, and so they could not expand the money supply. They couldn't respond to this, which is why in 1933 FDR did gold confiscation. The reason he confiscated gold was to be able, because it was linked to gold, the dollar was, in order to expand the money supply, he had to have gold. And so they did that, and that's when the economy started to improve. Basically, having a central bank and the ability to print money means that we'll never have a deflationary depression like we had in 1929. So I personally don't believe it's possible. I mean, anything is possible, but given the leadership that we have and the understanding that we have of economic reality, I don't think a deflationary depression is really in the cards in the future, as long as you can print money.
And we're recording this September 29th, 2020. How do you see coronavirus changing any of this?
Yeah, and I actually, in my economic forecast for this year, said we would see a semi V-shaped recovery, not quite as optimistic as a V-shaped, and in fact, it's working out. We saw about, I believe it was a 35% GDP drop. When the GDP is the size of the economy, it's the economic activity. That's massively severe. It's really, really, really bad. We are seeing right now, we're looking at Q3 GDP at being plus 30% from Q2. Insane. So there's been a pretty good recovery. There's a lot of pain, a lot of hurt. I'm not trying to minimize that, but the GDP has been boosted, and I just hats off to our government for the passing of the stimulus package. It really saved our bacon. Had they not done that, I would not be having this conversation with you. We'd be in a world of hurt, and because what happens is when businesses shut down and jobs disappear, a lot of times they just disappear forever. And so by by having the stimulus, it's keeping the economy from imploding and getting into a vicious cycle of deleveraging and job losses and deleveraging and job losses. So that scenario was avoided, and we do need another stimulus, I believe, and I'm hopeful that our leaders in DC will do that, and we'll be off to the races. But we're already seeing a plus 30% GDP growth for Q3. So, and the bottom line, fear sells. Fear, but hope makes money.
I love that. Do you have any other charts you want to share before we take it off?
Yeah, let's look at what else I got. So here's I talked about housing shortage. This chart is actually the housing shortage relative to population. So I basically scaled it by the growth in population, and I show that we're not even to the lowest point. We're not even up to the lowest point it's been in the prior 50 years. That the number of housing starts relative to population, it's just a huge shortage. Meanwhile, housing affordability is fairly strong. Again, let's cut out some of the higher priced places like San Francisco or New York City or other places. But this is the personal income is higher, and the relative to this median sales price of homes, low debt service. Again, because of the mortgage rates are low. And what's happened during the COVID crisis, people have used the crisis to actually pay down debt. So people's debt service is as low as it's ever been, since the 1980s. Low delinquency rates. Now this chart's a little old, so it has spiked up delinquency rates. Basically, my bottom line is the 2020 COVID crisis is not comparable to 2008. The 2008 crisis was created by speculation. 40% of homes sales in 2006 were for second homes, not happening today. Today, 80% of new mortgages have over a 700 FICO versus 50% in 2006. Gimmicks like no-doc loans drove the speculation, and today are possible. I've seen a few of these, but they're extremely rare. And really, it was Wall Street gimmickry and the sausage making that created the banking crisis. And today, banks are very, very healthy. If you look at all the banks have massively fixed their balance sheets, and their capital ratios are stronger than they've ever been. So it's nothing like 2008, and I'd love to debate anybody who disagrees, anybody with economic creds.
Well, thanks for sharing this optimistic economic outlook. This is kind of surprising and not what I expected. So, Bob, let's switch gears just a little bit here and talk about the strategies that you're employing right now to find profit.
We've got two strategies in single family residential mortgage notes. And we have one strategy in non-performing notes. We buy non-performing second mortgages. And we have another strategy in performing mortgages where we buy first and seconds that are reperforming. And our both strategies are doing very well.
Well, one of the things you talk about is becoming a lien lord as opposed to a landlord. Can you explain what that means? What is a lien lord and how you actually make money off of that?
Yeah, a lien lord is, so everybody's familiar with a landlord, right? You own a property, you rent it out, that you get mailbox checks, and that's great, except when they call, when you have the plumbing issue, the roof leaks, or they stop paying their rent and they need to evict, et cetera. And a lien lord is where you're the lender. So we're like the bank. So we own the paper, we own the debt on the house. And, I've yet to receive a call from someone saying, hey, fix my plumbing. I'm their banker, not their landlord. So it's way, way easier to scale. It's way less headaches. And there's just there's ultimate control and authority. So it's a far, but very similar in the sense that it's mailbox money.
And so you're talking about notes, which is something I'm familiar with, and I love investing in notes myself. You also use the term second mortgages or second liens. Explain what that means.
A second lien. So if you go out and buy a house, you get a lien on that house. That's a first lien. If you you can go out and refinance that house. Maybe you take out a second mortgage, you get a HELOC, a home equity line of credit, that creates a second mortgage. And both are mortgaged, both are secured by the property. But a first mortgage gets paid first. So if there was ever a liquidation scenario or foreclosure, the first mortgage gets paid 100% before the second mortgage gets a dime. So second mortgages are considered quite a bit more risky. But we love seconds. A lot of people hate seconds, and we're super happy about that. We love that people hate seconds because it makes them really, really good prices for us.
Well, explain why people hate seconds and why they're afraid of those. And then I want to know why you love them.
Well, people hate seconds because of the risk. So that's generally anybody with a little bit of financial experience. As soon as you say a second mortgage, they're like, don't talk to me anymore, get away from me, because they're considered trash or considered risky. Even banks, they have much higher, they're required to capitalize more, have higher capital ratios for seconds, higher interest rates. So they're generally considered risky because they're paid last. But I love seconds because I get better discounts. And I'll actually make a lot more money on seconds with very little risk because they're really not priced on risk. Okay, they're actually priced on fear. And so here's a perfect scenario. So you have a $300,000 house, okay, and you can buy on that house let's say a $100,000 first or a $100,000 second, okay, on a $300,000 house. So let's say you can buy the $100,000 first, and it's paying you 3% interest, and you can maybe buy it at a 10% discount. Okay, so your yield is going to be 3.3%. yield. Okay. Now, if in a foreclosure scenario or liquidation, you're fully safe. Okay, great. That home is refinanced, you make 10%, right? You paid 90 grand for that. So you get 10 grand, you feel good. Okay, but if I have that second mortgage, my coupon rate is maybe 7%. That yields a 7%, that $100,000. But I didn't pay $100,000 for it. I paid $50,000 for it because they're priced not based on intrinsic value. They're priced based on fear primarily. So I get a 7% coupon yield, but only paid half of that. So I'm getting a 14% yield. You follow me? But is my risk really that much higher? I would say not that much. Okay, maybe a teeny tiny bit, right? Not much. Furthermore, so I'm making a 14% yield versus a 3.3. Now add the fact when that home is refinanced. So if that home is sold or refinanced, that guy moves or refinances, well, his new bank will write a check to the first and the second mortgages to pay them off. So when I get paid off, I'm not going to get the $50,000 I paid. I'm going to get the $100,000 I'm owed. You follow me? So I make 14% yield until I make 100% capital gain. And what did I do for that? I collected a check. So I love seconds. I'll buy seconds all day long, and I'm so glad the world hates them.
How do you mitigate risk? Are you buying performing seconds that are of a certain quality, or explain what you look for when you buy these seconds?
Well, Brian, there's no such thing as a bad mortgage. There's only a bad price. So we underwrite everything to the nth degree. Okay, and we look at the way we underwrite. We're kind of financial geeks, but we look at every possible scenario, every possible outcome. So the first forecloses, they stop paying the second, year 3. We look at every possible scenario, and we actually come up with what's the value of that loan, that note, if that scenario happens. And then we weigh those based on our experience. What's likely? We underwrite to a 30% default likelihood, a 30% chance that they're going to do one of these really ugly scenarios, and that becomes the maximum price we pay. We've never yet paid that much. They're discounted far below what I call intrinsic value, and so we mitigate risk by not overpaying, and by very carefully measuring what are the possible outcomes and what is it worth if that outcome happens, and making sure that we make smart purchases.
Bob, can you give us an example, a real world example of a grand slam home run that you've hit on a second, and then also the worst case scenario that you've actually experienced on a second?
Okay, sure. So we got one note. I think it was an 11% coupon. We bought it at 50% discount. I think it was a $50,000 note, and we bought around $25,000. So our yield was around a little just shy of 20% current yield. He was a mail carrier, paid for 4 years. I think we got around $24,000 in payments, if I recall correctly, over the 4 years. He had a medical crisis 4 years ago. He'd quit paying the loan, but he had gotten back on track, and he paid off those bills, and he refinanced 4 years later, and we got $50,000. So we only paid $25,000 for it. We collected $25,000 in monthly payments, and we collected another $25,000 in profit. So we basically made 3 times our money on that note over 4 years. So that's as sweet. And the guy wrote us a really nice letter and said, "Thank you for not, kicking me out of my house, blah, blah, blah." And, there you go.
That's great. That's best case scenario. Let's hear a worst case scenario now. Worst
case scenario. The biggest risk of the seconds is if they stop paying the first. But the worst case is when they were paying the second and not the first. So this actually happened to us. So normally they stop paying you when you start paying attention. Well, we were on ACH. So we were having an auto withdrawal from their account to our note. So everything looked fine. And this note was actually in Mississippi. And Mississippi is what's called a rocket docket state. So rocket docket means foreclosures can happen in under 6 months. Complete everything. And there is no noticing requirement. So normally I get a legal notice when the first is foreclosed. So this lady quit paying, was paying the second, but not the first. And the first started foreclosure. The first didn't have to notice us. So we literally didn't know there was a foreclosure in place. And we were wiped out in 6 months.
So because the first lien holder foreclosed, you get nothing once that happens.
We didn't even know. And we didn't even know because of this. So that was a kick in the pants.
How about the ACH payment? Did those
We had our ACH payment. So that was crazy. That was nuts. So we learned to treat the rocket docket states with special care, and we learned to monitor the senior, which we'd done, but just not as aggressively as we needed to. Because honestly, we could have rescued that. There was enough equity in there. There's actually ways to protect ourselves where we can go and reinstate the first or write a check for all the arrearage on the senior mortgage to all of a sudden. So now they can't foreclose anymore. And then we step in with our own foreclosure. So we can protect our position, and we legally have the right to do that in most states. Because we didn't know, we were just shocked, So, but it was a $25,000 loss on a multi-million-dollar portfolio. At the end of the day, it was annoying, but didn't impact us.
Explain what you just described. You said you could have written a check to bring the first mortgage up to date.
Yeah.
And then filed a foreclosure on the second mortgage.
Right.
What exactly are you talking about?
Well, yeah, that's people don't realize, we get a lot of people to tell us, borrowers and others say, oh, you can't foreclose from second. Like, well, then what's the point of the lien? That's baloney. Anybody who says that just has no clue what they're talking about. You can absolutely foreclose from second. What really happens is banks will not do it. It is extremely complicated. My partner says, first mortgages are like checkers, second mortgages are like chess, and you really have to know a lot about what's going on. But we do it all the time. So literally the first mortgage, we'll write a check. We'll ask for a reinstatement. I have our lawyer ask the foreclosing lawyer for a reinstatement. We will write a check to them out of our pocket. So let's say it's a $25,000 note that we have, and there's a $25,000 arrearage balance on the first. Well, we write a check for $25,000. So now we're into that loan for more, but we've increased our equity by that much. So it doesn't cost us anything, in the sense of it just is transferring money from the left pocket to the right pocket. So we'll now the first cancels their foreclosure, and then we can go ahead and initiate our action. And so now we have the headroom where we don't have to worry about that first and the penalties and interest continue to accrue there that can take us out. And in some cases, we will continue to write monthly checks to the first mortgage.
So in filing foreclosure on the second, what's to prevent the first from getting the payoff or keeping that property because they're in first position?
Well, what happens in a foreclosure? So let's say there's several things that can happen in a foreclosure. So in a foreclosure, and the most likely, by the way, is the borrower calls you, okay, and does something, okay. But we only actually foreclose 1.5% of the time, okay, even on non-performing loans, 1.5%. We complete foreclosure. So it's a rarity. But let's say they did. So it goes to the auction. Well, at an auction, if the auction goes, what happens? The first will get the first money out, and the second will get the second money out, and the homeowner gets anything that's left over. And if there's not enough, the second won't get paid, the homeowner won't get paid, the second won't get paid, and the first may take a partial payment. Okay, that's scenario. If the second forecloses, the same scenario happens. But what we can do is we can also put in a protective bid. So let's say this thing goes to the steps, and we will put in a $50,000 bid. So worst case scenario, the property will come back to us. The title will come to us if there's not enough bidders at that price. You follow me? So the property will come to us, but it's still subject to the first. So we get title, But the second lien is wiped out. The first lien is still in place, and the loan is still in place. It's bizarre. It's bizarre. So literally, the original homeowner is on the loan, but we, but they're not in the home. So then we've actually got a property in LA, $800,000 property, subject to the first. We paid the first every month. We foreclosed, paid the first every month, flipped that house with the first mortgage the original first mortgage still in place, and flipped that house out, and it sold, and then that loan was satisfied.
Well, I can see why people are afraid of seconds, because what you just described is very complex. So you really have you really have to understand the ins and outs of how to work that legally. Yeah, it's chess. That's fantastic.
A good attorney can walk you through it. It's, you got to have good attorneys. You got to have good real estate knowledge. But again, those are really rare scenarios. They're not super common.
Yeah, it seems like you have the opportunity to get creative with those. Where do you source your seconds from? Are you buying from banks, individuals? How do you find them?
Almost all big pools from banks and hedge funds.
And what do they typically sell them at? 50 cents on the dollar of the unpaid balance?
For seconds especially, it's all over the map. So, for first, it's super common to get in the 50 to 60% range. For non-performing. Performing can go all the way up from 50 cents to par. For seconds, it's all over the range, really based on equity. So I've paid as little as 1 penny in the dollar for non-performing seconds, all the way up to, I've paid 70 cents on the dollar. So there's just a huge range based on equity and performance. So performing loans always are worth more.
And if you buy a non-performing second, what's your goal with that? Are you going to foreclose, or is there some other strategy you might employ?
Again, non-performing seconds, we only foreclose 1.5% of the time, 1.5. So almost always, about a third of the time, we do a loan modification. So we come up with a payment plan that the borrower can afford to keep them in their home. And sometimes, we'll adjust the interest rate, we'll wipe out arrearage balances or principal balances, and we can do a lot. That's the most common. The second most common, about 25% of the time, we do a settlement, a lump sum settlement. So they owe $100,000, write us a check for, $25,000, and we'll wipe out $75,000 of this debt, and the loan disappears. It's gone. So that happens.
And in the meantime, what would you have paid for that loan?
We typically, we would have paid at least less than half of that. So we typically are doubling. And then the third most common is a short sale. So, and as a second mortgage, we control a short sale. So we'll do what we call a friendly short sale. So we'll help them, get out of the house and put money in their pocket if it can work. And so we'll help them with a short sale. Those are the most common.
I love this topic of seconds. It's not something we've talked about on the show, and thank you for giving us good insight into how you do that. I want to talk about Aspen Funds, because I know that's your fund and you set it up. Can you talk about your business and what its purpose is and what you're actually doing through Aspen Funds?
We have 5 different investment funds and 2 strategies that I mentioned. So we have an income fund that buys performing notes, and we pay investors every month cash. And based on those, so it's a way to be in the note business without having to dirty your hands in the ugly details. And so that's an evergreen fund. It's been going on 8 years, never missed a preferred return payment. And it's got liquidity too. It's very cool because, so we have hundreds of notes in there. Well, every month, some of these notes get refinanced or sold. And so we have liquidity come in. Well, instead of going shopping, we can redeem people's investors' shares. So it has a built-in liquidity provision. It's very cool, very unique. And so it's a really great income vehicle for people that need income. And great business. And then we also have a serial non-performing second mortgage funds where we buy non-performing funds, and we basically raise a bunch of money from investors, go buy huge pools of notes. And then over the course of about a 3-year period, we send the money back to investors with profits.
What's the dollar amount that you might typically put into buying a pool of notes?
We're typically buying $1 to $2 million pools, our cost.
And are you leveraging existing relationships you have with these banks, or are you buying through brokers? I know I asked you where you're sourcing them from, but how are you making those inroads and those connections?
There's a lot of bank advisory firms that double as note brokers. And so that's a lot of our sources. We have also relationships with a number of hedge funds where we're their favorite buyer, and preferred returns with a couple banks as well. So that just continually, kind of go, a couple times a year, they go and, take out the trash. And we love their trash.
They take out the trash and call you, and if you want to buy
it. I got another pile of trash for you. We're like, yum, yum, send it over.
Briefly explain how you're solving their problems by doing that.
Well, for banks, once the loan goes non-performing, it's pretty negative. A lot of things are low dollar. The banks are not good at what they call loss mitigation, trying to figure out what to do with this. Okay, at that point, it's a loss. It's a cost center. They're trying to, and meanwhile, the capital requirements for banks. So banks are heavily regulated, and they're typically leveraged, 8 to 12 to 1. So they don't have a lot of margin. So what happens, and they're required to keep capital ratios. They can only lend and stay alive based on capital ratios of good loans. So what happens when a loan goes bad, they have to write that loan off at some point. And for seconds, especially, once a second goes into what's called non-accrual status, meaning it's not being paid by the borrower, they pretty much have to write it off to zero. So they have to sit it on their books at zero. Now the borrower still owes the money, and but on their books, they literally have it written off, and it's held at zero value. So at some point, they're not even incentivized to go and try and fix this. It's complicated. It's problematic. They don't have the staff to do that. So typically what will happen once a year, a couple times a year, they'll go and just sell that stuff off because they've already written it off, right?
So as we wrap it up, Bob, I want to give you the opportunity to tell our listeners how they might be able to get a hold of you or find out more about you.
Aspen, like the tree, funds, FUNDS, .US, Aspen Funds. .us.
And any final advice or words of wisdom for our audience?
Yes. And, with all this challenge that's going around and all this, there's so many people, afraid. And my advice is the best money is made when everybody's afraid. And so don't be afraid. Don't, go and figure out what you think is going to win and put your money there. It's interesting. JP Morgan made all of his money buying defaulted Russian government bonds, and he coined the phrase, the time to buy is when there's blood in the streets, and that's kind of a cold, crass picture, but it's the idea is when everyone else is afraid, you be buying. When everybody else is optimistic, that's when you want to be selling. So my advice, now's the time to make money. Just know where to put your money and know where the value is.
That's great advice. Thank you for that. And thank you for explaining to us why you're bullish on the housing market and sharing your charts and data. I think that's really eye-opening. I especially enjoy talking about mortgages and buying seconds and the process and the strategies that you're using to do that. And I know you're very big on being a lien lord, not a landlord.
Yes.
And I think we all have a clearer idea why that is after this conversation. So, Bob, thank you so much for sharing all of this with us today.
Pleasure to be with you, and all the best to all your listeners.
I want to thank everybody for listening to this episode. I'm your host, Brian Hamrick from Hamrick Investment Group, and you can find out more about me by going to higinvestor.com. That's higinvestor.com. And you can also ask questions and join us on Facebook by going to RPOA, Rental Property Owner and Real Estate Investor Podcast. This episode was sponsored by Green Property Management, managing everything from
from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.